If you've ever wondered how billion-dollar real estate deals are put together, then this video is for you. When it comes to monster deals, investors rarely use their own money and usually get funds from a bunch of different places in order to make the deal happen. Over the next 7 minutes, I'll break down how investors pull together funds through something called the capital stack to make multi-million and billion-dollar transactions a reality using other people's money. Then, I'll give you a real-life example of the capital stack. I'm Bishoy Habib, and I'm a deal-making real estate attorney. I've closed over 1,000 deals worth over $12 billion in my real estate career. The biggest deal I closed was a $1 billion airport deal here in Florida. As a deal maker, I've seen how complex big real estate deals can get. So today, I'm gonna break it down for you. When it comes to buying commercial real estate, like big office buildings or apartment complex, it's usually too expensive for an investor to buy outright with cash. That's why people usually team up and use different sources of money, which we call the capital stack. Here's how people fund these big real estate deals and what each part of the capital stack does. First, let's understand what a capital stack is. Think of it like a layer cake, where each layer represents a different type of money used to buy a property. The position in the stack matters because it determines who gets paid first and who takes on the most risk. In this analogy, the bottom layer of the cake is the safest, and the higher you go, the more risk you take on, but the more upside you have as well. At the bottom of the stack, we have senior debt. This is your typical bank loan, and it's the safest position because they get paid first if anything happens. Meaning, if the property owner defaults on payments, they have the right to foreclose and collect before any other lender or investor. That's why it's called senior. They're the first in line. Banks usually lend around 50 to 70% of the property value as senior debt, and they charge the lowest interest rate because they have the least risk and they can foreclose and recover their money if anything happens. Next up is mezzanine debt. Think of this as a second mortgage, but for commercial properties. Mezz lenders take more risk because they only get paid after the senior debt, so they charge higher interest rates to compensate for this additional risk. Mezzanine debt usually covers 10 to 20% of the deal after senior debt. Above that in the capital stack, we would see preferred equity. Preferred equity investors get paid after all the debt, but before common equity. Preferred equity is an interesting hybrid because it acts like both debt and equity. So these investors usually want guaranteed returns, which is debt, plus a piece of the profits, which is equity. This can be the next 10 to 15% of the deal after the mezz financing. And then at the very top of the capital stack, we have common equity, which is the most risky. Now this splits into two parts: the limited partners, who are silent partners that just invest money, and the general partners, or GP, who manage everything. The total common equity is usually around 10 to 20%, and lenders like to see the GP put at least 5 to 10% of equity to show they have skin in the game. Now let's show how the capital stack would look in real life. Let's say Igor, the investor, finds a multifamily property that costs $10 million. Igor has experience operating multifamily assets and has a great value add strategy to make the property worth more, but he doesn't have the $10 million to buy the asset outright. Igor does, however, have $500,000 saved up from prior deals he's done. To buy this property, Igor would first look for the cheapest way to borrow money, which is the senior debt, or a bank loan. Based on his track record of operating apartments, Bank of Florida agrees to give him a $6 million loan at a 7% interest rate, which is a great rate in today's environment. That's the lowest rate he can get because this is considered senior debt, which means the Bank of Florida gets their money first no matter what happens to the property. Since the loan is 60% of the purchase price, we call that a 60% loan to value, or LTV. Now, Igor still needs $4 million, so he goes seeking mezzanine debt, which is a second layer of borrowing. Since mezzanine lenders take more risk, they charge higher interest rates. In our example, the mezz lender agrees to lend $1.5 million in mezzanine debt at a 10% interest rate. Oftentimes, the mezz lender has a lien or mortgage against the property, but since that lien is in second position, they're not necessarily secured. So a mezz lender might require a secondary form of security, often in the form of pledged shares from the borrower. However, this may be fool's gold, as oftentimes the borrower shares are worthless if they're not making payments on the loan and the property's in default. This is a bit too in the weeds for this video, but just understand that the mezz loan is riskier than the senior debt. Okay, so we have a senior debt of $6 million. We just got mezz financing for 1.5, so now we're up to 7.5 million of the 10 million we need. So we need 2.5 million to get to closing. Now, since Igor only has $500,000, his next step is to find friends or partners who want to invest the remaining 2 million. And lucky for Igor, he's got two friends who want to invest. We got conservative Caroline and aggressive Andy. Conservative Caroline is only comfortable investing if she can get a guaranteed fixed return with a little upside, while aggressive Andy would rather swing for the fences, with the upside in equity. So Igor gets $1 million of preferred equity from Caroline by guaranteeing her an annual interest of 8% on her money, plus up to an additional 8% annually if the asset performs well. If the asset doesn't perform as expected and Igor stops making payments to the lender, Caroline would be third in line to collect her money after the senior lender collected their $6 million and the mezz lender collected their $1.5 million, plus of course interest and fees. And if the property's in default, there's probably not enough money left over to cover Caroline, leaving her in a bad spot if things go sideways. But that's why she's rewarded with a guaranteed 8% return with the potential of a 16% return to offset her risk. Andy, on the other hand, comes in for $1 million strictly as a limited partner. He is not guaranteed anything, but he has unlimited upside on the deal. So if the property doubles in value over the next 5 years, as Andy and Igor hope it will, Andy's $1 million equity investment as a limited partner will be worth $2 million. But if the project's a flop, Andy could lose all his money. Technically, Andy can get his money back after the senior lender, mezz lender, and preferred equity, but in reality, there's probably not going to be anything left at that point if the project goes sideways. In this case, even though Andy would technically own a part of the apartment complex, he's just a limited partner. He has no liability beyond his initial investment and no responsibility for managing the property. Igor does all the heavy lifting on the project, while Andy just puts his money in and collects his checks. Finally, lenders typically require the general partner, in this case Igor, to put some of their own money in the deal, so they have skin in the game. Typically, this is 5 to 10% of the deal, and in this case, Igor is putting up $500,000, which is the final 5% of the total project cost. Now, the investor is taking on a lot of risk, but can control a $10 million property with very little of their own money. This idea works for bigger projects too. This is the idea of the capital stack summed up. And this is how investors are able to leverage other people's money to buy enormous real estate projects that they could never sniff on their own. If you like this video and want to learn more about real estate investing, hit the like button and let me know in the comments what topic you want to talk about next. Thanks for watching, and don't forget to subscribe for more videos every week.